right, so what I'll do is I'll let Cliff just kick it off real quickly, and then it'll bounce to myself and then Ben, and we'll go from there.
All right, thank you very much, Mario. Thanks everybody for joining us today. Thanks, Ben, for today's presentation. As many of you have known, Steele Group puts on various presentations and seminars from our investment partners and different industry experts from time to time. EDGEPOINT is one of the close partners with the Steele Group, used in many of our clients' portfolios. And today we wanted to have EDGEPOINT in to give us an update on the investment philosophy, investor behavior, and some of the different things that EDGEPOINT does relative to other firms in the industry. So we do want to make sure that we highlight that difference, and we go through some great information today. Ben will be introduced by Mario. I will be on the call as well, but I'll be muted. We'll let Ben go from there. And again, thanks everybody for coming. I'll pass it off to Mario.
Perfect. Now, Ben, if you had attended one of our calls, I think it was about 1.5 years ago, we had Ben and Alan on the team, giving a bit of update on kind of a value of a business, how they like looking at businesses and valuations of companies. This presentation might touch on some of those topics, but also touch on kind of investor behavior. Just for a way background, Ben has been with EDGEPOINT for quite some time, as you can see his biography there on the screen. And he is a partner at their practice also. They have a shareholder program with all the regional managers and VPs within EDGEPOINT, and are a big believer in ensuring that all the people that work at EDGEPOINT are also investors within their portfolio. Give me 1 second here, I'll fix that in a moment. I apologize. Sorry, I just gotta do one thing here. Perfect. Just had someone with their mic on and I just wanted to mute it so it doesn't interrupt it too much. I apologize. Yeah, so prior to working at EDGEPOINT, I worked at Dominion Securities and also a few other companies, as you can see here. Just in terms of a bit of compliance, EDGEPOINT's more talking to unit holders of the fund, just not talking about actually specific trading or solicitation of that nature whatsoever. We'll be able to do a lot of Q&A throughout the presentation if anyone has any questions. But further to the presentation, if you want to talk to myself, Cliff, or Mark, we're available for you for any questions. So this is more of an educational kind of discussion along the way. I will pass it over to Ben now, so you can kind of kick it off. And we'll be really kind of this theme of investing with an emotional band and kind of more psychology on that part.
Great, thanks, Mario. Yeah, thanks everyone for joining us today. I know. I guess you guys are all unit holders or invest in our portfolios. We've also taken the time today to come and learn a bit more. So thank you for being on the call. As you can see up on the slide, the very first, or the title of our slide, we chose investing in a narrow emotional band. It's something that we strive to do every single day at EDGEPOINT, right? The stock market at periods of extreme, whether it's extreme optimism or extreme pessimism, can be irrational, right? And it's our job to understand what the value of a business is, and then take advantage of the prices that are presented to us in the stock market every single day. So, but before I jump in, I'll just touch on who we are as a firm at EDGEPOINT. So we started back in 2008. We are a privately held, investment-led organization. So we are, I guess, what most consider a mutual fund company, but we like to think we do it a little bit different than others. So investment-led means, we are making, I guess, every decision at our company is tasked with hopefully delivering the best long-term returns for our unit holders. So that is our number one goal. If we're going to be investment-led, we have to be, I guess, judged by our long-term investment performance. So goal number one is long-term performance at or near the top of our peer group over 10 years. Our second goal is partner with like-minded advisors. So, the Steele Group's a great example, right? We have quarterly updates. They grill me with questions, but we go through an update on everything within the portfolio. We are not trying to get, I guess, a dollar from everyone. We aren't built like other fund companies in that way. And then our third goal is an employee culture where employees think and act like owners. Mario hinted at it, but everyone is a partner at EDGEPOINT. If you call our main line, you will be speaking with a partner. We think that changes behavior with the internal employees and hopefully results in a better outcome long-term in our portfolio. So you'll see on the slide here, we have a number of bubbles, but just to highlight a couple, right? We only deal with 2% of the advisors in Canada. Our second goal, again, is investing or partnering with like-minded advisors, right? And then as well, our level of co-investment, you will see, not only are we equity holders in the business, but we're also one of the largest unit holders or investors in the portfolios. These are the same portfolios that you have your capital in. So if it's a good enough investment for our family and our investments, it's good enough for you as well. And as well, I mentioned long term, right? You'll I guess keep hearing us mention long term. You'll see $7.7 million in fees rebated to clients. So again, our goal at the firm is strong long-term performance at 10 years. We actually have a unique program at EDGEPOINT where if you've been a unit holder for 10 years, you actually get a management fee discount. So we've aligned, I guess, our portfolios with the unit holders as well. We think that leads to good investment behavior. So just moving on, Mario.
Yep.
Yeah, so I guess the investment team, these are the 15 individuals that manage the global portfolio and all of our portfolios on a day-to-day basis, right? And we would consider each individual on this page a business analyst, right? You'll see they have areas of specialty, whether it's fixed income or global equities. But at the end of the day, they're tasked with analyzing a business. You'll see Jeff McDonald and Ty Busada at the bottom. Those are two of our four founders. And they ultimately have the end decision making ability. But ideas can be contributed from each member of the investment team. So you'll see there's been cases, and we can walk through it maybe at the end if there's some questions about it, but Derek Skomorowski focuses predominantly on credit or fixed income, which is bonds lent to businesses. He's contributed ideas into the global equity portfolio as well. So a real collaborative approach, not siloed. Every week they're sitting down, debating ideas, understanding some of the risks and benefits to the businesses we own or businesses we're looking at. So, and that's it kind of for, I guess, who we are and the investment team that make a lot of the decisions. I guess one of the first things just to touch on is, we talked about, I guess, the difference between price and value, right? And I'm sure many of you on the call have heard of Warren Buffett. He has many quotes, and there's going to be another quote coming up in a couple of slides. But price is what you pay, and value is what you get, right? I'm sure you've heard this. It probably extends beyond investing. So it's something that we're always trying to, I guess, weigh every single day, right? Is are we getting a good value for the price we're asked to pay for a business? And if we go to the next slide, we'll see, we're going to use a quick example that I'm sure everyone on the call knows. And is an investment, Tim Hortons is part of a larger holding company now, but we own Tim Hortons when we first started, and now I guess we still own it through the business that acquired it many years ago. But this is an illustration on, I think most people on the call would understand what the price of a cup of coffee is. Now, if we go to the next slide, I realized after these slides went through compliance that I think a coffee is no longer $1.79. It's probably over $2. So that probably speaks to inflation, which is a topic for another day. But I think it'd be tough, for everyone on the call to come to a consensus on what the value of a Tim Hortons business, whether it's a franchise at the end of the street that you live on, or the entire entity, right? The value of a business, what is that business actually worth, right? And we'll get into a little bit how to value a business or what some of the inputs are in the business, but it's a much more difficult thing to answer, and that's what our investment team spends every single day trying to understand: what is Tim Hortons' value? And then if we move on to the next slide, I guess this is just an inherent trait within investing, is that investing is a zero-sum game, right? So you're either making a mistake or capitalizing on someone else's mistake, right? And it's unique because in other industries, you don't see this in other industries, right? If you're going to go for open heart surgery, you're going to want consensus among 1,000 cardiologists on the best way to do, the open heart surgery. Same with an engineer building a bridge. But just the nature of a zero-sum game, you do not want consensus within investing, right? Because at the end of the day, it is a zero-sum game. So if you're winning, someone else is losing. And that's ultimately how you earn an outsized return over the long term. So if we go on to the next slide. So I think we talked a little bit about, I guess, how we value business, right? At the end of the day, it's really what the assets of that business are and what the future cash flows of that business are, right? So that's how we can roughly figure out what the value of a business is. But at the end of the day, right, we use, I guess, that the modeling and what the, I guess, the inputs of that valuation is, and then we go out and buy an ownership stake in that business in the stock market. Now, stock prices change on a daily or on a minute by minute, second by second basis, but the value of a business doesn't change that frequently, right? So if we understand the value of a business, we can take advantage of that within the stock market to ultimately earn a better long-term return. Next slide. Yeah, and I think this is something we talk a lot about, right? I think with some of our meetings with Mario, Cliff, and Mark, right, is going back to, again, you don't want consensus within investing. You will see here the last, I guess, decade by decade, what are the largest businesses in the world. And what you'll notice is, you know, there's a theme every decade, but the theme never continues, and the top 10 businesses never happen to show up in the next following decade. So I think what we're really trying to illustrate here is that, you know, a good business doesn't necessarily always make an amazing investment, and that, you know, when you have consensus in investing and when you have everyone trying to do the exact same thing, like in the 1980s when 8 of the top 10 businesses in the world were all oil companies, you know, and again, going back to it being a zero-sum game, it's difficult for us to go in and understand how we can earn an excess return investing with everyone else in that same point in time. You know, you can see more recently 2020, and we've done kind of the 2 years following 2020. You know, I guess I'm sure you've seen a common theme within the large tech companies in the US. We don't own any of them currently because, you know, there's a point in time where we think the price appropriate for every business, but right now we think, you know, the price still doesn't make sense from what we think the value of that business is. So I guess how do we, at EDGEPOINT, you know, I guess we're trying to buy the growth of a business where, you know, the value isn't quite recognized in the share price today. So we say we have to know something that others don't, right? You know what everyone else knows, you really don't know anything at all, we say, right? You have to have a unique idea, or what we call a proprietary insight. So an idea about the business, why it's going to be bigger in the future, that's not reflected in the share price today. So, but you can see the illustration there is, but you have to think independently. You have to, I guess, do a lot of your own research and not just rely on some of the noise or headlines that you see on some of the big CNBC or BNN news outlets. If there's a question after, we can dive into an example, but I guess each proprietary insight is unique to each business. So it's not necessarily a formula that's repeated across every single industry, every single sector. It's unique to each business because, you know, we're valuing each business independently. So, all right, I promised another Warren Buffett quote. So, you know, to invest successfully over a lifetime doesn't require stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. You must apply the emotional discipline. And I think this ties back to, you know, investing with a narrow emotional band. You know, there's a lot of noise, there's a lot of irrationality in the stock market. And I guess the more that we can block that out and really just make informed decisions based on what we think the value of the business is and what we can buy that business for today in the stock market, we think the better off our unit holders will be, and the better off the returns will be over the long term. And I guess we'll quickly touch on, I guess, our definition of volatility. I think the industry or finance industry typically define volatility as, you know, there's many different calculations for it, but, you know, how much does an investment go up or down, right? So you'll see company B has quote unquote high volatility because the share price moves around a lot. But we don't consider volatility risk, right? We consider, our definition of risk is a permanent loss of capital, right? So whether you get a business wrong and it goes to zero, or you overpay for an exceptional business, but yet you paid a price well above what its value is. And if you go back, or just if you think back to the variation on the theme slide we previously showed, there's countless examples where, you know, the tech bubble in 2000, right? Many of those businesses, some of them are bankrupt, some of them are still down 20 years later. So going back to, does a great business make a great investment? Not always. So, so with volatility, we like volatility because, again, if we are an owner of that business and we understand what the value of that business is, we can take advantage of that in the stock market on your behalf. So we'll go back to the Tim's example. And again, we only show till 2014 because that was ultimately when Tim Hortons was taken over by what is now called Restaurant Brands. But I think it's a great example. First of all, I think most of you would know it, but it also, you can see as a business owner or analyzing the value of this business, right? Again, the value of a business is its assets and its earnings and all of its cash flows. You can see from 2007 to 2014, very pleasing growth in those earnings. Pretty steady, almost too steady, if you will, right? Every single year steadily increases earnings. But if we overlay on the next slide what the share price or the stock price is of Tim Hortons throughout that period of time, you can see there's periods where the share prices declined, in some cases materially. At every period, there was some macroeconomic, some headline, some reason why you should sell your investments. But again, we understood the value of the business and we were taking advantage of that along the way. Because again, volatility for us is more opportunity than it is risk. So, and I guess maybe going back to one of the previous slides, what we were saying, that, you know, on a day-by-day or a minute-by-minute basis, the share prices change, but the value of the business doesn't change over that period of time. So we are trying to take advantage of that when these kind of opportunities present themselves. So this is, we're showing here annual returns of the S&P 500. So the S&P 500, if you don't know, is one of the, well, deemed to be one of the most diversified indexes in the world. It is the 500 largest businesses in the US. What we're showing here is 40 years of calendar year returns. So the gray bars on top of the line are what every single calendar year return is. The black dots below is what the intra-year drop, or the pain you would have had to experience each year to ultimately earn the bar above the line. And what we're trying to really highlight here is volatility is a necessary part of investing, at least in the equity market, right? Is that, you know, it's not a risk-free return, and there is periods of time where there is volatility. But if you can go in with the understanding that there is volatility and you know the value of a business, that, again, going back, that is opportunity for us, right? And one of our founders, Ty, who's also co-lead portfolio manager, says, you know, volatility is the enemy of the investor that doesn't know the value of a business, but the friend of the investor that does. So, I mean, EDGEPOINT's been around since 2008, and for the last 14 years, each of these black dots has been a point in time where we are taking advantage of some of the downside, some of these stock prices trading lower, and really trying to look past all the headlines. Again, going back to the title of this presentation, investing in a narrow emotional band, right? Trying to block out all the noise and all the irrationality to really make an informed decision on, you know, is this business going to be bigger in the future? And, you know, can we buy it for less than we could yesterday? And so on and so on. So that's what we're trying to do every single day, is take advantage of these kind of swings in the market. So. And that was the S&P 500, but we're showing here the global portfolio, which I think most of the individuals on the call are invested in. And our portfolio is not immune to volatility either, right? But you can see there's 7 bubbles shown on the chart, and each period that's been an opportunity for us to take advantage of it. And also in 2011, you remember on the Tim Hortons slide, Tim Hortons was down 35%. That was a period of time where we were taking advantage of it. More recently, obviously, COVID in 2020, very uncomfortable period of time. What's interesting, it wasn't a financial crisis, it was a global health pandemic, but yet it trickled into the stock market. We were making long-term decisions back in 2020, decisions 5-10 years out on why we think these businesses will be bigger, and not what was maybe common practice or what was done by a lot of investors back then, which was, buy work from home, buy all these other stocks because, we're going to be locked up at home and working from our basements indefinitely. So again, it would have been very easy for us to go out and buy all those businesses in the work from home category. But again, working in a narrow emotional band, we were making those long-term decisions with ultimately, again, our first goal in mind. Can we have good, strong, long-term performance over 10 years, certainly above our peer group. So moving on. And I think, this is something that we talk a lot about. I think we've chatted with the Steele group and some other advisors that we deal with is, how to manage clients' emotions, right? Because if volatility is an inevitable part of investing in the equity markets, how can we at least stay invested, if not maybe add more capital? But what we're showing here is the MSCI World. So this is a global equity index tracking the 1,600 largest businesses of the world. What we're showing, the black line is its performance over the last 20 years. And what we're showing is the red and green bars are showing what the flows into portfolios or investments is throughout those kind of 20 years, right? And what it's really showing is it's pretty remarkable how predictable this is. But when the MSCI World is down, right, the red, investors are pulling their money out. It's scary, right? It's scary when you see an investment down. And conversely, right, when the investment comes up or recovers and is up, everyone wants to pile back in, which is kind of the exact opposite of what economics and finance is, right? Buy low and sell high. So the emotional part of it kind of takes over, right? And that's why we're trying to, block out as much of the emotion as possible and take advantage of it to ultimately earn that better returns, right? So if we go to the next one, this is actually kind of numerically what the data is showing. Now, I think I have to make a disclaimer. This is U.S. data, but we have to imagine, maybe not if it's the same numbers, but we think the gap still is there where the average investor underperforms the investment that they're invested in, right? So we have, if we look at the far left, under equity funds, again, the S&P 500 index we mentioned, over the last 30 years, it's annualized. So every single year, it's done 10.7%. The average client invested in that asset class has done 7.1. And it goes back to them buying and selling at the wrong period of time, right? Trying to pile in when the sun is shining and selling when, the market is volatile and it's uncertain, like March of 2020. And you can see the other two asset classes as well. Similar stories playing out. In fixed income, you're actually almost earning no return, which is kind of interesting. So I mean, at EdgePoint, we're trying our best to avoid this, right? And if we go to the next slide, we ran a similar comparison at EdgePoint where over the last 10 years, if a client's been invested with us for 10 years, because again, we're long-term investors, if they've been invested with us for 10 years, what is their average return? And what you can see is the dark orange bars on the left-hand side of the 4 different portfolios is what the portfolio's return is. So this is what you'll see on our website, on our quarterly fact sheets. But the lighter lighter bars to each right, the right of each portfolio is what the money weighted rate of return is. Now that's just a fancy way of saying what is the average client's rate of return after accounting for cash flows, right? So if you're running a pack every month or every quarter, right? Are you, I guess it's an all-encompassing calculation. And what it shows, as you can see over the last 10 years, the average client in EDGEPOINT portfolios has, it's minor, but has exceeded the return of the actual portfolios that they're invested in, this is what we love to see, right? Like, we want our end clients to actually experience the returns of the portfolios that they're invested in. So the only way to do that is if they're buying when the portfolios are down, and committing more capital along the way to earn a better compounded rate of return over the long term. And maybe I'll tell a quick story. There's a very famous portfolio manager in the US, he's since retired, but a guy by the name of Peter Lynch. He ran what was called the Magellan Fund at Fidelity. And he put up some of the best performance in the US, I think, ever. Over 13 years, he annualized at close to 30%. So every single year for 13 years, he did 30%. He doubled what the S&P 500 index had done. But that portfolio, if you looked at what the average investor's return was, they were actually negative. The average client lost money in a portfolio that for 13 years made a positive 30%. So that's what we're trying to avoid. And I think that's why we partner with advisors like the Steele Group to ultimately, I guess, give them the tools to understand our approach and help you guys through periods of volatility and navigate kind of all the uncertainty out there in the markets. So I'll maybe leave it at that. I think there's one more disclaimer, Mario, we have to show at the end.
It's coming up here. There we go. Index definitions. Yeah. There we go. Perfect. And yeah, the one thing I could also add in is I'm just going to go back to this slide, and this is experiences myself, Mark and Cliff do have worked with a lot of different portfolio companies out there. But one trend we do see is for companies that have wide access to retail clients, people who buy on discount brokerages, or just a lot of individual retail investors. That's what Ben was referencing with Fidelity portfolio. We've seen it with several other portfolio companies, also the same trend. If people are constantly hopping in and out on a whim, markets are down, time to sell, markets are up, time to buy, and kind of chasing the flavor of the month, you tend to see this massive gap. But we do notice this trend with companies that are less exposed to the kind of retail investors on that side. It gives their portfolio team a little bit more longer term focus. It's kind of the approach that EDGEPOINT has gone with, which is more of a trying to partner up with certain teams that have that longer term focus and allows them to kind of make longer term committed investments to throughout their portfolio. It kind of pays dividends on both ends, right? Investors tend to do quite well on that side. But yeah, and if you do have any questions, it's myself, Mark, and Cliff. We are available for any questions after the fact. If you want to email us, call us. And again, this portfolio will be possibly a part of your account. We do kind of stress the idea of diversification, and this is not really a pitch for EDGEPOINT in a sense. It's just more educational, kind of their thought approach to investing. But if anyone does have any questions, you can throw them into the chat. You can also unmute yourself. And like I mentioned, you can also just email us afterwards. Anything I missed, Ben, that you also wanted to touch on, or?
No, I think that's everything. Yeah, I mean, if there are questions, happy to answer any ones you have about EDGEPOINT or the portfolio. Please fire away. Perfect. Or if you want to ask them offline, please ask Mark, Mario, Cliff, and we're in constant communication, so they can fire them to me after if you like as well.
I think the only comment I would have, Mario, would be for clients, again, looking at all the folks that are on the call. Many of our clients know, as you mentioned, that the EDGEPOINT global portfolio is a very good complement to that growth end of their portfolio. And we do find the unique nature of EDGEPOINT in that particular portfolio, their approach to investing, a very good complement to the more I'll use the word traditional growth investments, which tend to be more focused in, as we saw up on the screen there, the Microsoft, Apple, the Amazon. Again, not that that has been a bad thing to be invested in during the last decade. But EdgePoint does provide a great deal of diversification, and in many meetings reviewing this investment with our clients, we've been very easily to show that EdgePoint does not necessarily follow the trend, and that is why we purchase it, and that is done intentionally, because in years when you see one particular sector that might be overexposed in lots of other portfolios, and even some that we use, EdgePoint is not there, and that's just the unique nature of EdgePoint, and that's worked very well for our clients over the last many years. One fun comment, if you go back to that slide, Mario, that had when investors put money in and take money out. I know for certain for a lot of my clients, when I talked about this one, the one that showed the fund flows, the one with the red and the green.
There we
go.
Yeah.
I always, and again, if you've had a meeting with me in the last little while, I'll always tell clients, do the opposite of what everybody else is doing. Do the opposite of what the news is doing. Whatever the news says, or great Uncle Louis says how to advantage your money. Do the opposite of that, and you'll be a millionaire. And this is a very good example. If you did the exact opposite of what the investors are doing here, not that we encourage day trading or anything like that, but if you buy when everyone is selling, and this clearly shows when everyone is selling right when they shouldn't be, you would do very, very well. So it's a great presentation, and thank you very much, Ben, for all the information, and Mario for arranging the presentation. And we'll leave it open to any questions that people have. And as Mario said, you can always reach out to anyone here in the office. I'm always happy to add more information on questions you might have about EdgePoint and the use of that in your portfolio.
Good afternoon, Cliff, Mario. Ben.
Hey, George, how's it going?
Can you hear me okay?
Yep.
All right, good afternoon, everyone. Thanks for the presentation, Ben. My question
Thanks, George.
is,
Thanks for attending.
given our current where we are in the market cycle, what foreseeable risks do you see in the next 12 to 24 months? Because there's a lot of panic going on, particularly over the last week or so, as a result of the bank situation in US and also in Switzerland.
Yeah, no, it's a great question. It's a question I get almost daily. And I think I'll maybe again bring it back to our investment approach, and then maybe we can talk about a couple of different risks out there. I mean, our investment approach again is really trying to focus on businesses and what are the individual businesses doing, and what are the ultimate exposures to that business, and how is it going to grow. So we determine in the industry called bottom-up investing. We are bottom-up investors, so we look at the businesses and not necessarily top-down, which would look at sectors and geographies and make a call necessarily on where to invest our money because of perceived risks or what GDP will do or what the central bank decisions will be. So with that, again, we try not to make 12 to 24-month predictions, but I mean, there's always uncertainty, there's always volatility in the market, right? Like if we go back, Mario, maybe to the we call it the bubble chart, but our performance, no, down one, yeah, this one, right, George, there's been periods over our history, right, a 14+ year history where, at each point in the bubble, right, there's been a period where we think investors think the world's ending, right? There's a risk out there. Like you'll see in back in the early, I think it was 2012, right? It was the European debt crisis. It was the pigs, Portugal, Ireland, Greece, and Spain, right? Greece was about to default on their debt, create a crazy amount of volatility. That was opportunity for us. If you were able to find a business that wasn't tied to anything in the Eurozone, and Tim Hortons is actually a great example. We were buying Tim Hortons that period of time. We can take advantage of it. So I don't know if that starts to answer your question, but I guess there's always risks. I think we're trying to make decisions about the businesses that we own in the portfolio and not try to anticipate these risks. Because for us, a lot of these risks, like we do not know what the outcome is of a lot of these perceived risks, right? Like no one thought there was a banking crisis. I don't want to say it's a crisis, but no one thought there would be a banking period of volatility a month or two ago, right? It was only an issue until it was kind of on the headlines of the news paper. So Does that answer your question?
Yeah, I mean, just a follow-up question is that with the tighter monetary policy that's been going around the world, and you guys do invest quite a bit on small caps and emerging markets. Therefore, I presume monetary policy will be hard to get by to these small caps, and particularly with emerging markets. Also, they have the headwind of strong U.S. dollar, although it's been coming down, but U.S. dollar is still fairly strong against world currencies. So,
yeah, I mean, currently we don't have a large emerging market weight. It'd be very small, actually. I mean, in traditional small cap, it'd be very little. It's more mid cap, which I think by U.S. definition is over $2 billion of market cap. So these are still quite large businesses, and because they're large, they're typically global in nature. So they have revenue streams from each corner of the world in some cases. So we're not trying to make a call on the U.S. dollar necessarily, but just in the topic of, I guess, tighter monetary policy, you know, we would actually welcome an environment where, you know, like what you see right now is where interest rates are in the U.S. The central banks aren't printing money indefinitely. That favors well for our approach, right? If we are, you know, trying to value a business and try to take advantage of the share price volatility, there's probably going to be more volatility, and there's probably going to be less kind of, I guess, less of a smooth ride that investors had experienced kind of from 2018 to 2020, where, you know, interest rates were very, very low, monetary conditions were very favorable, and in 2020, the central banks printed a lot of cash. That actually caused us to underperform because there was other investments that did very, very well. Like the price that people were paying for these businesses got very, very expensive, right? So we do not try to chase that. So in a tighter monetary environment, I think we should hopefully we should like our chances a lot better than when you know, call it 3-4 years ago, interest rates were much lower. So.
All right, thanks, Ben. I'll look forward to better returns then in the next 2 or 3 years. I know I like to hold Cliff accountable for these things, so I'll make a note to myself. Thank you.
I was asked to be on this call specifically so we could field questions from George.
The one thing I would actually, just for Ben, and you've touched on this in the past with us, but I think it's a great story, the Mattel story, when we're looking at COVID and looking at 2021, and it's kind of a lot of uncertainty. Is the economy going to be okay, not okay? What's inflation going to impact? And you kind of, at the time, we're talking about looking at companies with a moat. Again, the bottom-up approach, looking at good balance sheets, good quality companies. Do you mind just touching on that story a little bit, if you'd be willing? Or
yeah, Mattel, it's one of my go-tos, I guess, because I think when we talk about, you know, we have to have a unique idea, a proprietary insight to invest. I think this is a great example of us analyzing Mattel, valuing it. We think whatever its valuation is, and taking advantage of it because we think the share price or the stock market is maybe missing what we see in Mattel. So for those that don't know, Mattel is one of the largest toy manufacturers in the world. They own hundreds of different brands, most notably like Barbie, Fisher-Price, Hot Wheels, Thomas the Tank Engine. Those are the top ones I know. But in 2020, that stock really sold off, right? And the reality was, we were looking at that business and saw that they could actually see increased demand for toys being sold, because in 2020 everyone was staying at home and trying to find ways to entertain their kids. So that was, I guess, one part of the thesis. But the really long-term thesis to Mattel really revolved around their ability to monetize their intellectual property, so their IP. So what does that mean? Maybe I'll take a quick step back. I'm sure everyone on the call is familiar with Marvel and the Marvel universe. Marvel was obviously a comic book company, and it nearly went bankrupt in the late 90s because the people that ran Marvel said it was a comic book company, Disney came in and bought them, and Disney said, "You're not a comic book company, you're an entertainment company and content company." And now you can see, I don't know what the actual number is, but it's a multi-billion-dollar franchise within Disney, right? Because they create movies and everything there. Now, what's unique about Mattel is they have a library of over 100 different brands that they own the intellectual property for, but there's never been a Barbie's movie, never been a Hot Wheels movie, never been a Thomas the Tank Engine movie, go on and on and on. They've never really licensed out their intellectual property. And right now, I think it's 13 movies are being produced and created. Most notably Barbie. I think you've probably seen some advertisements. I think it comes out in June or July of this year. That's an avenue of growth that Mattel never had, right? And I think a lot of investors are just thinking quarter to quarter, are they going to grow their earnings more than last quarter? We're thinking out much longer term, right? And it's been the share price has been very, very volatile over the last little bit. But again, we understand what the value of Mattel could be, and we think 5-7 years. Any of that kind of short-term volatility is an opportunity for us to add more because we're taking that long-term approach to Mattel. That kind of cover it all, Mario? Did I miss anything?
Yeah, I think it's a fascinating story, and it's more about kind of the idea behind EDGEPOINT being that bottom-up approach, kind of how they look at a company, they look at the balance sheet, the company, there's a moat around it, there's sometimes limited barriers for competition or something that makes that company half decent at what they do. But then that long-term story, kind of looking at where could Mattel grow, going back to Hortons, the expansion of restaurant brands in the Tim Hortons brand to the UK, to the US, other parts. If you go back 15 years ago, the idea of seeing Tim Hortons in England and the US at this level was unheard of, but it's having that long-term vision of, yes, they're a good company and make good earnings, and we're going to have difficult times in different time periods, whether it be 2008, whether it be COVID and things of sort that have happened, or even what's happening in recent weeks. Are these companies earning revenue? Do they have a clean balance sheet? And is there that potential to continue to expand, right? So that's the idea I find of EDGEPOINT that's appealed to us. And yeah, and as always, again, going back to myself, Mark, and Cliff, we're happy to discuss how different portfolios obviously make sense for each client, right? So any other questions at all that anyone has, or quiet audience tonight, which is okay. For myself, works out perfect. My son's soccer tournament is later on tonight. He's we'll see if he wins a medal. I got a feeling all the kids will get a medal, but that's usually still an exciting day.
Awesome. Excellent. Great presentation, Ben. Thank you for that information. And I'm sure we'll have another presentation coming up in the next little while for another one of the partners that we work with at the Steele Group. Information from another company or financial planning topic. We'll be sending out invites for that probably in the next month or two. Great. Thanks everybody for attending, and we did record the session. We'll make it available on our website, and we'll send that out or put that up on our website, and you'll get a notification when that is available.
Thank you. Thanks.
Thank you. Take care, guys.
All right. Thanks, everyone. Have a great day.